Question 1. An applicant for a life insurance policy in California has a free look period that typically begins on what date? A. The date the application is submitted. B. The date the first premium is paid. C. The date the policy is delivered to the owner. D. The date the underwriting process is completed. Answer: C. The date the policy is delivered to the owner. The free look period, also known as the right to examine period, is a specified number of days, usually 10 to 30 in California for life insurance, during which a policy owner can return the policy for a full refund of premiums paid, no questions asked. This period is crucial for consumer protection as it allows the policy owner to review the contract thoroughly and ensure it meets their needs without financial penalty. It begins when the policy is physically or constructively delivered to the policy owner, not when the application is submitted or premium paid, because that is when they actually have the opportunity to review the final contract. This ensures the consumer has adequate time to examine the actual policy document. Question 2. Which of the following statements regarding the incontestability clause in a California life insurance policy is true? A. It prevents the insurer from denying a claim for any reason after the policy has been in force for 1 year. B. It allows the insurer to contest a claim due to material misrepresentation only during the first 2 years of the policy. C. It applies only if the insured dies as a result of suicide within the first year of policy issuance. D. It voids the policy if a non-material misrepresentation is discovered at any time. Answer: B. It allows the insurer to contest a claim due to material misrepresentation only during the first 2 years of the policy. The incontestability clause is a standard life insurance provision designed to protect the policy owner from an insurer denying a claim based on misstatements made in the application after a specified period, typically 2 years from the policy's issue date. During this initial 2-year period, the insurer can investigate and deny a claim if it discovers a material misrepresentation, a false statement that would have caused the insurer to deny coverage or issue it differently. After this period, the insurer generally cannot contest the policy's validity, even if a material misrepresentation is later found, unless it relates to a fraudulent statement, like impersonation. This clause provides certainty for beneficiaries, ensuring the policy proceeds will be paid. Question 3. In California, what is the primary purpose of the California Life and Health Insurance Guarantee Association, CLHIGA? A. To protect policyholders in case an insurer becomes insolvent. B. To regulate insurance rates and ensure they are fair. C. To investigate claims of insurance fraud. D. To license and monitor insurance agents and brokers. Answer: A. To protect policyholders in case an insurer becomes insolvent. The California Life and Health Insurance Guarantee Association, CLHIGA, was established to protect policyholders and beneficiaries in the event that a member insurer becomes financially impaired or insolvent. It functions by stepping in to pay covered claims and continue coverage up to certain limits when an insurance company fails. This provides a crucial safety net for consumers, similar to how the FDIC protects bank deposits, ensuring that people do not lose their life insurance benefits or annuity values due to an insurer's financial collapse. Understanding that this association protects consumers helps reinforce the stability of the insurance industry. Question 4. All of the following are types of term life insurance policies except A. Level term. B. Decreasing term. C. Increasing term. D. Endowment. Answer: D. Endowment. Term life insurance provides coverage for a specific period of time, and its death benefit can be level, decreasing, or increasing throughout that term. An endowment policy, however, is a type of permanent life insurance that matures at a specific age or date, paying out the face amount either upon the insured's death before that date or to the policy owner if the insured is still living at maturity. Unlike term insurance, endowment policies build cash value and are designed to pay out even if the insured outlives the policy term, making them a distinct category from pure term coverage. Question 5. In California, which of the following is not a characteristic of a participating life insurance policy? A. It allows policy owners to share in the insurer's surplus. B. It is issued by mutual insurance companies. C. It pays dividends to policy owners. D. It guarantees a fixed annual premium for the life of the policy. Answer: D. It guarantees a fixed annual premium for the life of the policy. A participating life insurance policy, typically issued by mutual insurance companies, allows policy owners to share in the insurer's divisible surplus through the payment of dividends. These dividends are not guaranteed and are essentially a return of a portion of the premium paid if the insurer has a profitable year. While whole life policies, which are often participating, do have fixed premiums, the characteristic of participating specifically refers to the policy owner's ability to receive dividends, not the guarantee of a fixed premium. This distinction is important because dividends are not considered taxable income since they are viewed as a refund of an overpayment of premium. Question 6. If a California life insurance policy includes a waiver of premium rider, what typically happens if the insured becomes totally disabled? A. The insurer will pay the policy's cash value to the insured. B. The policy will lapse immediately. C. The insurer will waive the premium payments, and the policy will remain in force. D. The death benefit will be reduced by the amount of premiums waived. Answer: C. The insurer will waive the premium payments, and the policy will remain in force. A waiver of premium rider is an extremely valuable benefit added to a life insurance policy that protects the insured in the event of total and permanent disability. If the insured becomes totally disabled, typically after a waiting period, example 6 months, the insurer will waive all future premium payments for the duration of the disability, and the policy will continue to stay in force as if premiums were being paid. This means the policy's death benefit, cash value accumulation, and any other benefits remain intact, preventing the policy from lapsing due to an inability to pay. This rider is a crucial safeguard for policy stability during difficult times. Question 7. According to California law, what must happen before an insurer can legally use an applicant's HIV test results for underwriting purposes? A. The applicant must give informed written consent. B. The applicant must sign a waiver of confidentiality. C. The applicant must undergo genetic testing. D. The test results must be disclosed to the applicant's physician only. Answer: A. The applicant must give informed written consent. In California, an insurer cannot require an applicant to undergo an HIV test or use the results of such a test for underwriting purposes without first obtaining the applicant's informed written consent. This consent form outlines the purpose of the test, how the results will be used, and assures confidentiality, protecting the applicant's privacy rights. This strict requirement ensures that individuals are fully aware and agree to this specific medical examination before any testing takes place, adhering to important ethical and legal standards regarding sensitive health information. Question 8. In California, what is the maximum free look period for a variable life insurance policy? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: C. 30 days. While most life insurance policies in California have a 10-day free look period, variable life insurance policies are required to have a longer free look period of 30 days. This extended period is due to the inherent investment risk associated with variable policies, which involve separate accounts and are regulated as securities. The longer free look period provides the policy owner with more time to understand the complexities and risks of the investment-based nature of the policy before committing to it. This extra time is a crucial consumer protection for more complex products. Question 9. Which of the following statements about California's replacement regulations for life insurance policies is true? A. They are designed to encourage policy owners to replace existing policies with new ones. B. They primarily benefit the agent by streamlining the sales process. C. They require agents to provide a notice regarding replacement to the applicant. D. They only apply if the new policy is issued by a different insurance company. Answer: C. They require agents to provide a notice regarding replacement to the applicant. California's replacement regulations are designed to protect consumers when an existing life insurance policy or annuity is being replaced by a new one. These rules aim to ensure that the replacement is truly in the policy owner's best interest, as replacing a policy can often involve surrender charges, new contestability periods, and higher premiums due to increased age. A key requirement is that the agent must provide the applicant with a notice regarding replacement to highlight the potential disadvantages of replacement and ensure the policy owner makes an informed decision. This notice helps prevent practices like twisting, where an agent convinces a policy owner to replace a policy for the agent's financial gain. Question 10. A policy owner in California wants to assign ownership of their life insurance policy to a bank as collateral for a loan. This is known as what type of assignment? A. Absolute assignment. B. Collateral assignment. C. Vested assignment. D. Irrevocable assignment. Answer: B. Collateral assignment. When a life insurance policy is assigned to a bank as collateral for a loan, it is known as a collateral assignment. In this type of assignment, the policy owner retains all other rights of ownership, and the bank, the assignee, only has a claim to the policy's death benefit up to the outstanding loan amount. If the insured dies, the bank is paid first, and any remaining death benefit goes to the named beneficiary. This differs from an absolute assignment, where all rights of ownership are permanently transferred to another party. This is a common way for policy owners to leverage their policy's value without fully giving up control. Question 11. In California, what is the primary purpose of the entire contract provision in a life insurance policy? A. To allow the insurer to amend the policy terms at any time. B. To ensure that the policy and the application constitute the entire agreement. C. To prevent the policy owner from assigning the policy. D. To define the cash value accumulation schedule. Answer: B. To ensure that the policy and the application constitute the entire agreement. The entire contract provision states that the life insurance policy itself, along with the application, a copy of which must be attached to the policy, constitutes the entire agreement between the policy owner and the insurer. This means that no statements made by the agent or in any other document can be used to alter or contradict the terms of the policy. This provision is crucial for consumer protection as it prevents the insurer from later introducing evidence outside of the written contract to deny a claim or change policy terms, ensuring that the policy owner has a complete understanding of their coverage by reviewing the physical policy document. Question 12. Which type of life insurance policy is characterized by a flexible premium, flexible death benefit, and cash value that fluctuates based on investment performance in a separate account? A. Whole life. B. Universal life. C. Variable universal life. D. Term life. Answer: C. Variable universal life. Variable universal life, VUL, insurance combines the flexible premium and adjustable death benefit features of universal life with the investment component of variable life. The policy's cash value is held in separate accounts, chosen by the policy owner, and grows or declines based on the performance of those underlying investments, making the cash value growth non-guaranteed. This product offers maximum flexibility but also carries investment risk, meaning the policy owner bears the risk of poor investment performance. This contrasts with traditional universal life where the cash value growth is typically credited with a guaranteed minimum interest rate. Question 13. According to California law, what is the maximum interest rate an insurer can charge for a policy loan on a fixed premium life insurance policy? A. 6% fixed. B. 8% fixed. C. A variable rate not to exceed the published monthly average for corporate bonds. D. Either a fixed rate not exceeding 8% or a variable rate. Answer: D. Either a fixed rate not exceeding 8% or a variable rate. California law allows insurers to charge either a fixed interest rate on policy loans not exceeding 8% per annum, or a variable interest rate. If a variable rate is used, it must be determined at regular intervals, at least annually, and must not exceed a specified index, typically the published monthly average for corporate bonds or a comparable index. This flexibility allows insurers to adapt to market conditions while ensuring policy owners are not charged excessive rates for borrowing against their own policy's cash value. It's important to remember that outstanding policy loans reduce the death benefit paid to beneficiaries. Question 14. Which life insurance rider provides for an additional death benefit if the insured dies as a result of an accident? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Cost of living adjustment, COLA, rider. Answer: B. Accidental death benefit rider. The accidental death benefit, ADB, rider, often called double indemnity, pays an additional amount, typically equal to the policy's face amount, hence, double, if the insured's death is caused directly and solely by an accident, as defined in the policy. This rider does not cover death from natural causes or certain specified exclusions like suicide or war. It's an affordable way to enhance coverage for a specific type of risk, providing extra financial protection for beneficiaries in the event of an unforeseen accidental fatality. Question 15. In California, what is the purpose of the Buyer's Guide for Life Insurance? A. To provide a list of all licensed insurance agents in the state. B. To help consumers compare different insurance products and make informed decisions. C. To outline the specific terms and conditions of a particular policy. D. To serve as an application form for life insurance. Answer: B. To help consumers compare different insurance products and make informed decisions. The Buyer's Guide is a generic informational booklet that explains basic life insurance concepts, common policy types, and how to choose the right policy. It's designed to help consumers understand the important features of life insurance and compare different products offered by various companies, thereby facilitating informed decision-making. In California, agents are generally required to deliver a buyer's guide along with a policy summary, or disclosure document for annuities, at or before the time of application. This ensures transparency and empowers consumers. Question 16. An insurance agent who misrepresents policy terms to induce an applicant to lapse an existing policy and buy a new one is engaging in the illegal act of A. Rebating. B. Twisting. C. Churning. D. Defamation. Answer: B. Twisting. Twisting is an illegal unfair trade practice in California where an agent misrepresents the terms, advantages, or disadvantages of an existing life insurance policy to induce a policy owner to lapse or surrender it and purchase a new policy with the same or a different insurer. This practice is prohibited because it often results in the policy owner losing valuable benefits, such as a lower premium rate based on their original issue age, or incurring surrender charges. Churning is a similar illegal practice but specific to replacing an existing policy with a new one from the same insurer primarily to generate new commissions. Question 17. Which of the following best describes the grace period provision in a California life insurance policy? A. The period during which the policy owner can return the policy for a full refund. B. The period after the premium due date during which the policy remains in force without payment. C. The period during which the insurer can contest the validity of the policy. D. The period before the policy's cash value begins to accumulate. Answer: B. The period after the premium due date during which the policy remains in force without payment. The grace period is a crucial policy provision that allows the policy owner a specific number of days, typically 30 or 31 days in California for life insurance, beyond the premium due date to pay an overdue premium without the policy lapsing. During this period, the policy remains in full force, meaning that if the insured dies during the grace period, the death benefit will still be paid, usually with the overdue premium deducted. This provision prevents immediate lapse and provides a safety net for policy owners who might be a few days late with a payment. Question 18. Under California law, an applicant for a life insurance policy must be given a Notice of Information Practices, which informs them about A. The agent's commission structure. B. How the insurer will collect, use, and disclose personal information. C. The policy's cash value surrender charges. D. The insurer's financial rating. Answer: B. How the insurer will collect, use, and disclose personal information. The Notice of Information Practices is a document that California law requires insurers to provide to applicants. Its purpose is to inform the applicant about the insurer's practices regarding the collection, use, and disclosure of personal information, including details obtained during the underwriting process, like medical records or credit reports. This notice is part of consumer privacy protection, ensuring transparency about how an applicant's sensitive data will be handled. It helps individuals understand their rights regarding their personal information. Question 19. If a life insurance policy in California has an automatic premium loan provision, what is its primary function? A. It automatically pays the annual premium from the policy's cash value if the premium is not paid by the end of the grace period. B. It automatically extends the policy term if the insured cannot pay the premium. C. It provides a loan to the policy owner for any emergency without requiring a loan application. D. It automatically converts a term policy to a whole life policy after a certain period. Answer: A. It automatically pays the annual premium from the policy's cash value if the premium is not paid by the end of the grace period. The Automatic Premium Loan, APL, provision is a valuable non-forfeiture option that protects a cash value life insurance policy from lapsing due to unpaid premiums. If the policy owner fails to pay a premium by the end of the grace period, the insurer will automatically take a loan from the policy's accumulated cash value to cover the premium, keeping the policy in force. This loan accrues interest and reduces the death benefit if not repaid, but it prevents an unintentional lapse, which is critical for maintaining coverage. Question 20. In California, the right to refund of premium upon cancellation is guaranteed for how many days after an individual annuity contract is delivered? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: C. 30 days. For individual annuity contracts in California, the free look period, referred to as the right to refund of premium upon cancellation, is a minimum of 30 days from the date of delivery. This extended period, similar to variable life insurance, is mandated because annuities are complex financial products often involving significant sums of money and long-term commitments, including surrender charges. The 30-day period gives the annuitant ample time to review the contract and decide if it meets their financial goals, allowing them to cancel for a full refund if not satisfied. Question 21. Which type of life insurance policy is often referred to as permanent and accumulates cash value that can be borrowed against? A. Renewable term. B. Convertible term. C. Whole life. D. Annual renewable term. Answer: C. Whole life. Whole life insurance is a type of permanent life insurance that provides coverage for the insured's entire life, as long as premiums are paid. A defining characteristic of whole life is its guaranteed level premium and the accumulation of a cash value, which grows on a tax-deferred basis. This cash value component can be accessed by the policy owner through policy loans or withdrawals, or it can be surrendered for its cash value. This differs significantly from term insurance, which only provides coverage for a specific period and typically does not build cash value. Question 22. Which of the following factors is not typically considered in the underwriting process for a life insurance policy in California? A. Applicant's health history. B. Applicant's occupation. C. Applicant's race. D. Applicant's hobbies/avocations. Answer: C. Applicant's race. Underwriting for life insurance involves assessing various factors to determine the level of risk an applicant presents and to set appropriate premiums. While factors like health history, example medical exams, doctor's statements, occupation, example hazardous job, and hobbies, example skydiving, are legitimate considerations for risk assessment, an applicant's race is strictly prohibited from being used as an underwriting factor in California and across the U.S. This prohibition is in place to prevent discrimination and ensure fair and equitable treatment of all applicants regardless of their racial background. Question 23. An insurance agent provides an applicant with a written illustration for a life insurance policy. According to California regulations, what must the illustration clearly state? A. That the dividends are guaranteed. B. That the values shown are projections and not guarantees. C. The exact date the policy will mature. D. The agent's personal income from the sale. Answer: B. That the values shown are projections and not guarantees. Life insurance illustrations, particularly for policies with non-guaranteed elements like universal life or variable life, must prominently state that the projected values, such as cash value growth or death benefit, are based on assumptions and are not guaranteed. This disclosure is crucial for consumer protection, as it manages expectations and prevents applicants from mistaking projected values for certain outcomes. The illustration helps potential policyholders understand how the policy might perform under different scenarios, but it must always highlight the non-guaranteed nature of future values. Question 24. What is the primary purpose of a viatical settlement in life insurance? A. To allow a terminally ill insured to sell their life insurance policy for immediate cash. B. To transfer policy ownership to a family member upon the insured's death. C. To convert a term life policy into a whole life policy. D. To allow an insurer to purchase another insurer's block of business. Answer: A. To allow a terminally ill insured to sell their life insurance policy for immediate cash. A viatical settlement allows a terminally ill insured, typically with a life expectancy of 2 years or less, to sell their life insurance policy to a third party for a lump sum payment that is less than the policy's face amount but more than its cash surrender value. This provides immediate financial liquidity for the insured, often to cover medical expenses or improve quality of life, at a time when they need it most. The viatical settlement provider then becomes the new policy owner and beneficiary, collecting the full death benefit upon the insured's passing. Question 25. In California, if a life insurance policy lapses due to non-payment of premium, how long does the policy owner generally have to reinstate the policy? A. 3 months from the lapse date. B. 6 months from the lapse date. C. 1 year from the lapse date. D. 3 years from the lapse date. Answer: D. 3 years from the lapse date. The reinstatement provision in a California life insurance policy allows a policy owner to restore a lapsed policy, one that has terminated due to non-payment of premiums, within a specified period, typically up to 3 years from the date of lapse. To reinstate, the policy owner usually must pay all overdue premiums with interest, provide proof of insurability, example pass a medical exam, and repay any outstanding policy loans. Reinstatement is often preferable to purchasing a new policy because it retains the original issue age and policy terms, potentially avoiding higher premiums.